Here's a brutal truth that will save your trading account. Jesse Livermore didn't make his fortune by predicting market direction. He made it by knowing exactly when the market confirmed his thesis. This distinction between prediction and confirmation separates legends from losers, millionaires from broke dreamers who thought they could outsmart Wall Street with clever analysis and perfect timing. Picture this. It's October 1929. The Roaring Twenties are reaching their euphoric peak. Headlines scream about endless prosperity. Shoe shine boys give stock tips. Ordinary people become millionaires overnight. The collective intoxication is complete. Fortunes multiply daily, while the nation celebrates its financial genius. Yet amidst this widespread optimism, Livermore quietly builds the largest short position in Wall Street history. He's not acting on doom prophecies or gut feelings. He's responding to something far more reliable, his timing signal flashing red. The newspapers praise the new era of permanent prosperity. Brokers work around the clock, processing buy orders. Margin accounts explode as everyone leverages their way to riches. But Livermore sees what others miss. The market's character is shifting beneath the surface euphoria. The quality of rallies deteriorates. Response to good news becomes muted. Reactions to negative developments grow more severe. His confirmation signal triggers with unmistakable clarity. That signal, hidden in plain sight but invisible to amateur eyes, turns a $3 million position into $100 million in just weeks. While millions watch their life savings evaporate, Livermore multiplies his wealth 30-fold. The difference isn't luck, insider information, or superior intelligence. The difference between amateurs and professionals isn't intelligence or capital. It's patience. It's the discipline to wait for the market to show its hand before committing serious money. Amateurs act on hope and hunches. They see a setup developing and immediately think, this is it. Their hearts race with excitement as they envision profits rolling in. They load up based on conviction, not confirmation, risking substantial capital on educated guesses. They confuse good stories with good trades, mistaking analysis for action signals. Their positions become hostages to hope. Hope is not a trading strategy. Professionals see the same setup and think, show me. They understand something fundamental that amateurs never grasp. Your initial idea is never an investment. It's an experiment. You're paying tuition to learn what the stock wants to do next. You're gathering intelligence about whether smart money agrees with your thesis. This shift in perspective changes everything. Instead of betting the farm on conviction, you test waters with measured risk, ready to expand or retreat based on market response. Consider the psychology here. The amateur craves certainty, so he pays for it with losses. The professional accepts uncertainty and rents clarity as it appears. He buys information with small risk, then leverages confirmation. Price confirms. Not your opinion. That one line can save years of pain. It reframes your identity completely. You are not a predictor. You are a risk manager who reads behavior. The secret isn't complex indicators, sophisticated algorithms, or insider information. It's recognizing when the market itself validates your thesis through one unmistakable behavioral pattern. Livermore called it the moment when the line of least resistance flips, when the path of least effort for price movement suddenly changes direction. This signals that underlying forces driving the market have fundamentally shifted. Supply stops winning, and demand takes control, or vice versa. Most traders ignore this signal because it requires doing one thing they refuse to do: wait for the stock to prove them right before risking real money. They're addicted to action, confusing activity with progress. They'd rather be wrong quickly than right slowly. This impatience costs fortunes because they never distinguish between their opinion about what should happen and the market's demonstration of what actually happens. Waiting is a position. Waiting is risk control. You don't force the lock, you watch for the click. You trade only after the door opens by itself. When nothing confirms, you do nothing. That's not avoidance. That's professional control of exposure. Small first, add only on proof. Protect capital with position size before protecting it with stop losses. This is why smart traders make catastrophically dumb timing mistakes, and it has nothing to do with their analysis being wrong. Their fundamental analysis might be brilliant, Their technical setups might be textbook perfect. Their understanding of market dynamics might be sophisticated and nuanced. But they fail because they act on analysis instead of waiting for confirmation. They mistake being right about direction for being right about timing. They confuse good ideas with good timing. Livermore learned this the expensive way. Early in his career, he would nail direction and still lose because timing was wrong. He was early, and early often equals wrong. He fixed it by demanding specific confirmation before scaling up. The confirmation was simple: immediate response and staying power, not a pop and fade. A surge that holds, invites more buying, and refuses to retreat to old levels. That character change marks the shift in control. You're about to discover the exact confirmation mechanism Livermore used to separate himself from the crowd. The precise behavioral pattern that allowed him to time entries and exits with legendary precision. But first, you need to understand why intelligent, well-informed traders consistently destroy accounts through poor timing decisions. The answer will surprise you because it reveals a fundamental misunderstanding about what trading really is and what the market tells you when you place a trade. The thing amateurs refuse to do? Test the market's response before committing serious capital. This single behavioral difference separates consistent winners from consistent losers. Yet most traders never grasp its importance. They believe their analysis entitles them to profits. They spend hours researching and forming opinions, then mistake those opinions for market reality. But the market cares nothing for your analysis, no matter how brilliant. It only responds to the collective actions of buyers and sellers, and those actions often contradict the most logical predictions. Consider two traders analyzing the same breakout at $50. Both have done their homework. Both understand the technical setup showing months of consolidation between $47 and $50. Both recognize the fundamental catalyst driving potential upside. The chart looks textbook perfect. News flow turns positive. Everything aligns for a breakout above resistance. The amateur sees resistance breaking and immediately buys 1,000 shares at $50.25. His reasoning? It's breaking out. I can't miss this opportunity. His conviction runs high because his analysis looks solid. His $50,000 position is now hostage to hope. He's betting that his interpretation of events matches reality, that his timing aligns with market forces, that other participants will validate his thesis immediately. Every tick against him feels like personal failure. The professional sees the same break, but buys just 100 shares at $50.25. Same entry price, same timing, radically different approach. Why the smaller size? He's not betting on the breakout, he's testing it. He understands that breakouts fail more often than they succeed. He knows that resistance levels attract sellers who've been waiting to exit. He's not making a statement about where the stock will go. He's asking a question about where it wants to go right now. This is Livermore's first timing principle. Your initial position is never a commitment. It's a probe. You're gathering intelligence about what smart money is really doing behind the scenes. You're testing whether your thesis aligns with the intentions of participants who move markets. The difference in psychology is profound. The amateur's large position creates emotional attachment to being right. The professional's small position creates emotional detachment. He can observe objectively because his financial exposure remains manageable. If that test position immediately moves in your favor with strong volume and no hesitation, the stock is telling you something critical. Other informed money agrees with your thesis. The immediate response reveals the balance of power between buyers and sellers. Strong, sustained movement suggests that your breakout caught the attention of participants with serious capital. Weak, hesitant movement suggests that resistance remains formidable despite the technical breach. Here's the protocol. Start with 25% of your intended position size. This isn't arbitrary, it's calculated risk management. If you plan to risk $10,000 on the trade, you start with $2,500. If the stock moves decisively in your favor within the first 30 to 60 minutes, showing persistent buying pressure and holding its gains, that's your confirmation signal. The market is proving your thesis worthy of a larger commitment. Watch the tape during those crucial first minutes. Does the stock surge past $50.50 and hold? Does volume expand as price advances? Do pullbacks find support above the breakout level? These behaviors indicate genuine accumulation, not false breakouts designed to trap retail traders. The stock acts like it wants to go higher, not like it's struggling to stay above resistance. The amateur sees his small position, making money, and thinks, I should have bought more. He regrets his conservative sizing. He feels foolish for not maximizing his exposure to obvious profits. His focus shifts to missed opportunity rather than confirmed opportunity. The professional sees the same profit and thinks, now I can buy more. He feels satisfied that his test worked. He's earned the right to increase exposure because the market validated his thesis. This immediate, sustained response to your probe is Livermore's secret timing signal, not the setup itself, but the market's decisive reaction to your test. The setup gets you interested. The confirmation gets you invested. You're not trading patterns on charts. You're trading behavior of participants who control price movement. Your small position becomes a sensor that detects the intentions of larger players. Let me give you a story. Two traders, same ticker, same morning. Sam loads 1,000 shares at $50.25 with a stop at $49.80. He risks $450 but feels obligated to hold because the position is big for him. The stock pops to 50-50, then stalls, then slips under 50. He freezes, widens his stop, and ends the day down 12,000 after a panic flush. Maya starts with 100 shares, same entry, same stop, risking $45. When the stock stalls and fails to hold gains within 40 minutes, she scratches near break-even. Later, the stock resets, blasts through the morning high, and holds. That's when she adds 200 more and rides a $2 move. Same setup, different identity, different process, different results. The protocol continues. If confirmation appears within 30 to 60 minutes, add another 25% of your intended size. You're now 50% invested with clear evidence that smart money supports your direction. Each addition requires fresh confirmation, not hope that initial momentum continues. You protect capital with position size before protecting it with stop losses. But here's where most traders destroy themselves. They mistake any green in their position for confirmation. A quick pop from $50.25 to $50.40, followed by sideways drift, isn't confirmation, it's distribution. True confirmation requires both immediate movement and staying power. Next, we'll define exactly what genuine confirmation looks like and distinguish it from the false signals that trap even experienced traders. Real confirmation isn't just a green candle. It's the market demonstrating sustained conviction at critical junctures. Livermore understood that stocks reveal their intentions through behavior, not just price movement. Most traders never grasp this distinction, which explains why they lose money despite identifying correct setups. They see any upward movement and assume validation. But movement without conviction is just noise. Price tells you what happened. Behavior tells you what's happening. The difference determines whether you're following smart money or walking into a trap designed to separate you from your capital. Here's what genuine confirmation looks like in practice. Your test position at $50.25 immediately moves to $50.75 on heavy volume. No pullback, no hesitation, no struggle against obvious resistance. The stock acts decisively, suggesting buyers are more motivated than sellers at this critical level. But amateurs celebrate too early. The real test comes next. Does it hold? This is where professionals separate themselves from the crowd through disciplined observation. Over the following 30 to 60 minutes, you watch the tape with scientific precision. The stock doesn't just maintain $50.75. It attracts more buyers, pushing toward $51 on expanding volume. Each wave of buying brings fresh participants. Bids step higher while offers vanish quickly. The stock acts like it wants to go higher, not like it's struggling to stay up. This is what Livermore called natural movement, price advancement, that appears effortless because supply and demand are clearly imbalanced in favor of demand. Compare this to false confirmation that traps retail traders daily. The same stock pops from $50.25 to $50.75, then immediately stalls. Volume dries up. Price drifts sideways or slips back toward the breakout point. Offers refresh while bids retreat. This behavior suggests the initial move exhausted available buyers at these levels. Smart money isn't accumulating, they're distributing to eager retail traders who mistake any green candle for validation. The protocol removes emotion from decision-making through precise criteria. Initial probe. 25% of intended position on the breakout. This sizing protects you from catastrophic losses while providing meaningful exposure to gather market intelligence. You're not maximizing profits on first entry. You're minimizing risk while testing whether your thesis aligns with market reality. Volume confirmation. Trading volume 150 to 200% above the 20-day average. This threshold ensures your breakout attracts serious institutional attention. Light volume breakouts typically fail because they lack participation necessary to sustain momentum. When volume expands dramatically, it signals the move caught attention of players who can actually move markets. You want the tape to get loud, spreads to tighten, and institutional flow to validate your timing. Price behavior. Wide range bar closing in top 20% of its range. This separates strong breakouts from weak ones. A stock opening at $50.25, trading to $51, but closing at $50.40, shows internal weakness despite apparent strength. A stock closing at $50.90 demonstrates buyers controlled the entire session. The close reveals who won the day's battle between buyers and sellers. Staying power. Holds gains for minimum 30 to 60 minutes without significant pullback. This filter eliminates head fakes and false breakouts that reverse quickly. Genuine breakouts maintain gains because they reflect fundamental shifts in supply and demand dynamics. The stock doesn't surrender new territory because sellers aren't motivated to offer shares at these prices. Micro dips should be shallow and quickly absorbed, with bids stepping up rather than stepping away. Time filter. If confirmation doesn't appear within 2 hours, cut the position. This rule prevents hope from overriding discipline. You're testing a thesis, not making a long-term investment. If the market doesn't validate your idea quickly, it's probably wrong or poorly timed. Cut losses fast and preserve capital for better opportunities. Waiting is a position, but waiting too long becomes wishful thinking. When these conditions align perfectly, probe launched. Volume surging 150 to 200% above average. Wide range. Close in top 20%. Gains held for 30 to 60 minutes. Add your second 25%. The stock has earned the right to larger commitment by proving other smart money is accumulating. This isn't averaging up on hope, it's pyramiding on proof. Each addition requires fresh confirmation, not faith that momentum continues. Consider the identity shift embedded in this protocol. The amateur asks, is my position green? The professional asks, how strong, how long, how broad? Strong means distance traveled with authority. Long means duration through the confirmation window. Broad means participation with institutional volume and clean tape action. If any element is missing, confirmation is incomplete. You're not paid to guess which element will appear later. You're paid to wait until all three align simultaneously. Here's a scenario to sharpen your judgment. Same breakout triggers. Lifts from $50.25 to $50.50. Then chops sideways as volume fades below average. Pullbacks pierce the breakout line and linger. The tape shows offers refreshing while bids retreat. That's not confirmation, that's a stall. The professional scratches the probe or reduces size immediately. The amateur rationalizes, widens, stops, and transforms a test into a hope trade. Livermore's rule was absolute. Price confirms, not your opinion. Your analysis might be brilliant. Your timing might seem perfect. But none of that matters if price doesn't validate your thesis immediately and decisively. The market's sustained response to your probe reveals everything about the balance of power between buyers and sellers. You're not imposing your will on the market, you're discovering the market's will and aligning with it for maximum profit potential. This system works because it forces you to trade with the line of least resistance rather than against it. When confirmation appears, you're joining smart money already accumulating. When confirmation fails, you're avoiding traps that catch traders who act on conviction rather than evidence. But even this rigorous system has a dangerous flaw that can destroy disciplined traders if they don't understand the next principle. Success breeds overconfidence. After a few profitable pyramid trades, traders start seeing confirmation signals everywhere. They begin treating normal market noise like meaningful validation. Their judgment becomes clouded by recent wins, and they lower their standards for what constitutes genuine confirmation. Every green candle looks like opportunity. Every minor breakout appears worthy of commitment. This deterioration in selectivity marks the beginning of their downfall because the market teaches its cruelest lesson to those who mistake luck for skill. Livermore learned this the hard way in 1906. After months of meticulously applying his pyramiding strategy on Union Pacific and Northern Pacific, his confidence soared. His timing had been flawless. His position sizing had maximized gains while controlling risk. His confirmation protocol had identified genuine accumulation patterns repeatedly. He felt invincible, as if he'd cracked the market's code permanently. Then came the setup that appeared identical to previous winners. A stock consolidated after a strong advance, then attempted to break higher on what appeared to be expanding volume. Livermore saw familiar patterns and acted quickly, adding significant size based on what he thought was genuine confirmation. But this time was different. He mistook a quick pop for genuine confirmation, added size based on loose criteria, then watched helplessly as the position reversed and wiped out weeks of carefully accumulated gains. The lesson was brutal and unforgettable. Even professionals can confuse random movement with real signals when success makes them careless. This painful education led to Livermore's second timing principle: distinguish between false and true confirmation with scientific precision. A quick pop followed by sideways action isn't confirmation, it's distribution. Smart money uses retail enthusiasm to unload inventory at favorable prices. They create the appearance of breakouts to attract buyers, then sell into that buying pressure. Real confirmation shows persistent accumulation that continues building momentum over multiple sessions, not struggling to maintain levels after initial advances. The stock doesn't just break higher, it holds gains, attracts additional buying, and demonstrates that supply is genuinely exhausted at lower levels. Here's the advanced protocol for secondary ads that prevents overconfidence from destroying discipline. First, pause requirement. 3 to 7 sessions of tight ranges, with declining volume after initial confirmation. This consolidation period allows the stock to digest gains and build energy for the next leg higher. Impatient traders exit during this phase, transferring shares to stronger hands. Volume should contract as fewer participants are willing to sell at these elevated levels. Second, secondary signal. Fresh, wide-range day through the consolidation. High with spread greater than or equal to 1.2 times the 20-day average true range. This ensures the breakout demonstrates genuine power, not just modest improvement. The stock must show expanding volatility in the direction of the trend, indicating renewed institutional interest. Narrow range breakouts typically lack the energy necessary to sustain momentum. Third, ad sizing. 50 to 75% of initial probe, never larger. This prevents position size from growing beyond manageable levels, even when confirmation appears perfect. Each addition should be smaller than the previous one, creating a pyramid structure that maximizes profits during strong trends while limiting exposure to reversals. The largest risk should be on the most confirmed part of the position. Fourth, stop placement. Under the consolidation low, not the original entry point. This gives the position room to work while maintaining logical risk control. The stop should be placed where the story breaks below levels that would invalidate the accumulation pattern. Moving stops too close to current price often results in premature exits during normal volatility. Fifth, trail protocol. Move stops only when price forms defendable higher lows that maintain the integrity of the uptrend. Don't trail stops based on arbitrary percentages or time periods. Wait for the stock to create natural support levels through pullback patterns. Each higher low represents a successful test of demand at elevated levels, justifying tighter risk control. Consider the difference between two traders facing the same scenario. Ryan sees 3 quiet sessions and grows impatient. On the 4th day, he adds big into the chop because he's due. The stock spikes 10 cents, stalls, then slides back into the range. He's forced to stop under noise he volunteered to trade. Mia waits through 5 sessions of tight action and declining volume. On day 6, volume expands, range widens, and price powers through the pivot. She adds half a probe and moves her stop under the base. Notice the emotional difference. Ryan felt pressure to act because previous trades worked. Mia let the market write the rules, the counterintuitive truth that separates professionals from amateurs. Buy higher, risk less. Each successful test reduces uncertainty, while hope increases it. When you add after consolidation and re-breakout, you're buying proven strength with reduced uncertainty. The stock has demonstrated its ability to hold gains and attract additional buying interest. Livermore called this pyramiding at points of least resistance. You're not chasing price higher based on fear of missing out. You're following strength that the market has validated multiple times through different tests. But mastering this system requires one final element that separates legends from losers: knowing when to do absolutely nothing. The final element, Livermore mastered: the discipline to walk away when confirmation isn't there. His most profitable years weren't when he traded the most, they were when he traded the least. Doing nothing is a trade. Flat is a position. This paradox confuses modern traders who equate activity with progress. But Livermore understood that selective inaction often generates more wealth than frantic action. Every trade you don't take preserves capital for opportunities that actually deserve your money. Most traders think trading is about finding opportunities. They scan charts, read news, analyze fundamentals, and convince themselves that constant engagement leads to constant profits. Livermore knew trading is about ignoring everything except the right opportunities. The skill isn't identifying potential setups, it's rejecting 90% of them because they lack confirmation necessary to justify risk. Professional traders are professional rejectors. They say no to almost everything so they can say yes with maximum conviction when genuine opportunities appear. When your test position moves sideways for 2 hours with no sustained momentum, what do? This moment reveals your true trading identity. The amateur holds, hoping for eventual confirmation. He rationalizes the lack of movement by creating new narratives. Maybe it needs more time to build momentum. Perhaps institutional buyers are accumulating quietly. He turns a failed timing signal into a long-term investment, violating every principle that could keep him profitable. Hope transforms a precise test into an emotional attachment. Position sizing discipline disappears as he convinces himself to hold larger risk than originally planned. The professional cuts immediately. No confirmation means no commitment. The absence of expected behavior is itself meaningful information. When the market doesn't respond as anticipated, professionals assume their timing is wrong and act accordingly. They don't debate the market or try to convince it to behave differently. They accept the feedback, minimize damage, and preserve capital for better opportunities. 3 failure signals demand immediate action, removing emotion from decision-making through objective criteria. Time failure. No sustained movement within 2 hours of entry. This filter eliminates positions that lack immediate momentum. Genuine breakouts typically show strength quickly because they reflect pent-up demand finally expressing itself. If your test position goes nowhere for 2 hours, the market is telling you that demand isn't as strong as your analysis suggested. Volume failure. Expansion on pullbacks, contraction on advances. This pattern reveals distribution disguised as accumulation. Smart money uses retail enthusiasm to unload inventory, creating volume spikes when price retreats, and volume droughts when price advances. The tape shows more interest in selling than buying despite apparent technical strength. Character failure. Wide-range reversal bars that close in the bottom 20% of their range. Picture a stock that surges higher, breaking resistance, only to form a large candle that closes near its absolute low for the period. This behavior suggests that initial enthusiasm was met with overwhelming selling, completely reversing the price action. It's a powerful statement that your thesis is wrong. Right now, here's the exit protocol that transforms failure signals into manageable losses. First, trim. Bank 3 times your risk on initial units when momentum shows exhaustion. If you risked $100 on your test position and it moves favorably but starts showing fatigue, take $300 profit on part of the position. This locks in gains while maintaining exposure for potential continuation. Hard stop. Keep original stop under confirmation days low until new higher low forms. Don't move stops closer based on hope or fear. Let the position have room to work, but maintain discipline about where the story breaks. Time stop. If position goes nowhere for 5 to 7 sessions, reduce size regardless of paper profit or loss. Stagnant positions tie up capital that could be deployed more productively elsewhere. Consider Maria and Tom, both holding the same failed breakout after 2 hours of sideways action. Maria cuts her 100-share test for a $45 loss and moves on. Tom holds his 1,000-share position, hoping for eventual confirmation. 3 days later, the stock gaps down on negative news. Maria lost $45. Tom lost $4,500. Same analysis, same entry, different position sizing and exit discipline. Livermore's numbers tell the story. He was wrong, 60 to 70% of the time, but still generated massive returns. How? By keeping losses small through position sizing and letting winners run through confirmed pyramiding. When you start with 25% positions, failed tests cost you 25% of a small loss instead of 100% of a large one. Mathematics works in your favor when you control the downside while maximizing upside through disciplined additions to confirmed strength. The legendary timing signal isn't just about when to buy more, it's about when to buy nothing at all. Waiting is a position. When you're not losing money, you're preserving capital for moments when confirmation is unmistakable. Cash is optionality. The market doesn't pay you for being busy, it pays you for being right at the right time with the right size. But mastering these individual elements means nothing without understanding how they fit together into a complete, actionable system you can implement immediately. You now possess Livermore's complete timing system, the confirmation signal that built fortunes while others lost everything. This isn't theory or wishful thinking. This is the precise framework that generated massive wealth during the most volatile periods in market history. From the panic of 1907 through the crash of 1929, these principles work because they align with timeless market dynamics that never change. Fear, greed, and the collective behavior of participants who move prices through their actions, not their opinions. Your blueprint transforms random trading into systematic speculation through 5 interconnected elements. First, identify the setup but resist loading up immediately. Start with 25% of intended size. This disciplined approach protects you from catastrophic losses while providing meaningful exposure to gather market intelligence. You're not maximizing initial profits, you're minimizing initial risk while testing whether your thesis aligns with current market reality. The setup gets you interested, but confirmation gets you invested. Second, probe the market's response with scientific precision. Look for immediate movement, with 150 to 200% volume expansion, wide range closes in the top 20%, and the ability to hold gains for 30 to 60 minutes without significant pullback. These criteria eliminate false breakouts and identify genuine accumulation patterns. The market must prove your thesis worthy of additional commitment through decisive action that demonstrates smart money agreement with your timing. Third, add on confirmed strength through disciplined pyramiding. When the market proves your thesis correct, pyramid 25% more. Then wait for secondary consolidation, 3 to 7 sessions of tight ranges with declining volume before considering final additions. Each add requires fresh validation, not hope that initial momentum continues. You're building positions at points of least resistance, following strength that the market has validated multiple times through different tests. Fourth, cut failed signals fast without emotional attachment. No confirmation within 2 hours means preserve capital immediately. Time, failure, volume failure, character failure, any one demands immediate action. Failed tests are tuition for learning market behavior, not investments deserving patience. The absence of expected confirmation is meaningful information that your timing is wrong, regardless of how compelling your analysis appears. Fifth, trail with discipline by banking profits into momentum exhaustion, while keeping stops where the story breaks, not where fear screams. Move stops only when price forms defendable higher lows that maintain trend integrity. Take partial profits at 3 times your initial risk when momentum shows fatigue. but let confirmed portions run until technical damage appears. The numbers prove the system's mathematical advantage. Livermore's timing protocol allowed him to be wrong 60 to 70% of the time, while still generating massive returns. Here's how the math works. Suppose you risk 1R on initial probes. 7 losses cost 7R. But 3 winners that travel 6 to 8R after pyramiding recover all losses and generate substantial profit. Position sizing keeps losses small when you're wrong. Confirmation keeps you aligned with smart money when you're right. Pyramiding on proof, not hope, maximizes winners while controlling risk through measured additions to strength. This is the fundamental difference between gambling and speculation that separates professionals from amateurs. Consider 2 traders spotting the same consolidation breakout. Jake analyzes fundamentals, studies charts, and concludes the stock should rally. He buys 1,000 shares at $50, risking $10,000 based on conviction. The stock immediately reverses, and he holds, hoping for recovery. Final result, negative $7,000. When stopped out weeks later, Sarah sees the same setup but starts with 100 shares at $50, risking $500 to test market response. The stock pops to $51 on heavy volume and holds gains for 45 minutes. She adds 100 more shares, then another 100 after secondary consolidation confirms continued strength. Final result, positive $4,000 on a 300-share average position. Same setup, different process, radically different outcomes. Gamblers bet big on predictions based on analysis, hope, and conviction. Speculators test small, then commit big only when the market validates their thesis through immediate, sustained response. Your edge isn't predicting what stocks will do, it's recognizing when they're ready to do it. Prediction requires forecasting future events. Recognition requires observing current behavior that reveals underlying supply and demand dynamics. The system creates asymmetric risk-reward through position sizing and selective action. You'll trade less frequently but with higher conviction. You'll risk smaller amounts initially but achieve larger returns through pyramiding confirmed strength. You'll experience more small losses but fewer large ones, creating positive expectancy through mathematical advantage built on discipline, not prediction. Cut losses fast, size positions small, wait for confirmation, pyramid on strength, and own your process. These 5 principles built Livermore's legend, and they'll build your consistency. Price confirms, not your opinion. Waiting is a position. Buy higher, risk less. Small, first, add-on proof. These maxims become armor against the emotional storms that destroy undisciplined traders who confuse activity with progress. Implementation requires patience and discipline, but the rewards justify the effort. When nothing confirms, nothing is the correct position. When confirmation appears, act decisively but methodically. Let the market tell you when you're right before risking serious money. This transforms emotional trading into mechanical execution based on objective criteria that remove hope and fear from decision-making. If this timing system clicked for you, the next crucial skill is learning how Livermore identified which stocks were worth testing in the first place. His method for spotting true market leadership before the crowd catches on. But for now, you have everything needed to begin implementing professional-grade timing discipline that separates consistent winners from the hopeful masses who trade on conviction rather than confirmation.